Welcome to Conversations, a weekly audiocast featuring interviews with leading investment strategists and recognized financial professionals. Brought to you by the Market Technicians Association.
This is Conversations, the official MTA podcast series, and today's guest is Michael Carr. Michael Carr, CMT, is the author of two investment books, Smarter Investing in Any Economy, The Definitive Guide to Relative Strength Investing, and Conquering the Divide, How to Use Economic Indicators to Catch Stock Market Trends. Mike is a member of the Market Technicians Association and editor of the MTA's newsletter, Technically Speaking. He has served as a director of the MTA Educational Foundation, promoting the value of technical analysis to the academic community. Welcome to the program, Mike.
Thank you so much, Lance. It's nice to be here.
Thank you for coming on. Most people listening today will recognize you as the editor of the MTA Technically Speaking newsletter, but a lot of your service has been behind the scenes. So you were a director of the MTA Educational Foundation. Can you tell me a little bit about that?
The MTA Educational Foundation may not be as well known among our membership as obviously we'd like it to be. The purpose of the Educational Foundation is to get technical analysis being taught at the university and college level. Fundamental analysis is very well taught at those levels, but a lot of the academic literature supposedly says fundamental analysis trumps technical analysis in all cases, and technical analysis is equivalent to voodoo. So what we do is we find friendly professors and go in generally with a half-day seminar about technical analysis to show that the students want to learn more about it and that it's not voodoo. The professors are generally receptive to that, and then it begins a years-long process or more to get it added to the academic calendar. Academia tends to move very slowly, so although the professor may say, this is great, I want to teach the class tomorrow, often we end up with a bureaucratic process that requires years, while MTA members go in and do guest lectures in various classes. And those are always well received. I've never heard of one that wasn't actually well received. I had the honor of going down to Fort Lewis College in Colorado when Charlie Kirkpatrick was teaching the course down there. And at the end of the course, I expressed disappointment to Charlie because one student fell asleep. And he told me, don't worry about that. Usually 5 fall asleep. You did great. So college for our older members doesn't seem to have changed much since we went. Many students aren't taking advantage of all the opportunities. But the Educational Foundation is very determined to break through and get in there. They recently concluded what is now a semi-annual fundraiser, maybe a little commercial. For October-November timeframe, be watching for the Take a Technician to Lunch fundraiser again. There's always a great list of names there. And even if you don't bid, just make your clients aware or make your readership aware that this is going on, and that's always very helpful to the organization.
Sure. Now, were you exposed to technical analysis when you were in college? What is your background?
Yeah, I was not. I went to college and got a degree in chemistry. And at the time, chemistry was a lot easier because we didn't even have computers way back then. After college, I went into the Air Force and was exposed to computers. And while working on some military programming projects, I saw a copy of Investor's Business Daily on the newsstand one day, and it hit me that those stock charts looked an awful lot like some of the problems we were trying to deal with. Basically, an uptrend in a stock chart is very equivalent to the first half of the trajectory you see in a missile. So the math is pretty much the same, to my mind. So I started looking at different approaches to stock market that were more quantitatively based. Not as easy back in the late 80s, early 90s as it is now to do that kind of stuff. But I rapidly saw that a lot of the math was the same. The literature at the time was also not as plentiful. And academic studies all talked about this idea of momentum, which was an anomaly to the efficient market hypothesis. And momentum was simply relative strength. It was identified in the early 90s in academia. as something that worked. Technicians had long known about it and been using it for a number of years. And I just realized that was something I wanted to key in on, and just worked on relative strength from a more quantitative approach than pure technical chart reading at the time.
Now, it's very clear that you read a lot just from the editing that you do in the Technically Speaking every month, and it's clear that you write a lot from the 2 books that you've written, and I see articles in Stocks and Commodities magazine. Tell me what a typical day looks like for you.
I think a typical day is up before the markets to see the news, what's going to impact the markets. I like writing about that type of stuff, some of the economic data, to help me see what's important. Every Thursday morning before the market opens, for example, new unemployment claims comes out. And that number is very volatile. The economics reporting always includes the 4-week moving average, kind of a technical tool that they don't acknowledge as a technical analysis tool, but they claim it's better to look at that. What I find is if you dump that data into a stochastic formula, it kind of makes sense more. You can see the highs and lows, you can see the movement through time of the new claim, and you convert high-frequency economic data into a meaningful number. That number recently turned bearish. It actually crossed above 50 a couple of weeks ago, and jobless claims is rising now relative to the recent past. That has use to me. That means, maybe the economy is slowing. We should be watching. So the day starts with the economic news and trading around the opening. I like opening range breakout type systems. They're what I consider to be day trading, not high frequency day trading. You're able to get your order together in the first half hour of trading, put a trailing stop, a market on close order on it, that's it. You're done day trading within a half hour of the open. Through the day, just market watching and researching, a little bit of writing, and then after the close, checking those equity accounts to make sure that there were no errors, nothing to worry about, and just following up with more research ideas and writing.
Now, do you consider yourself a trader who writes or a writer who trades?
I think it's more a trader who writes. I consider the priority to be what covers the mortgage and the monthly bills. I mean, I'm not that thinker, so if the trading covers that and the writing certainly doesn't, that's the focus for me more so.
Okay. So I want to circle back with the writing and the trading. Your book, The Smarter Investing in Any Economy, The Definitive Guide to Relative Strength, is just a fabulous book. Very well written, easy to understand, and so many good tools in there around relative strength. And you said Investors Business Daily pushed you towards technical analysis, and Investors Business Daily certainly has a relative strength component to it, but what you've done in your book is taken it much deeper than that, and you said you understood that you wanted to specialize in that in the early 90s, but at what point did you say, this is the area that I want to be an expert in, and I've come far enough where I can write a definitive guide, and I can publish a book on this topic when other people had gone before you? I mean, at that point, so you had Robert Levy in the late 60s that had done some work on it. You had Charles Kirkpatrick that had done some work at that point. And then in the you had Bill O'Neill with Investors Business Daily in the early 90s. Who was doing work then? O'Shaughnessy?
Correct.
So there had already been some foundation laid, but yet you were able to still break new ground.
Well, I think it hit me about a year before the book came out that there wasn't a book on relative strength. There was a knowledge of relative strength among professionals. Among the retail investor, they understood there was an RS rank for IBD, but they didn't even understand that the timeliness rank of value line which was very popular among individual investors until a few years ago. I'm not sure if it's as widely followed now. But they didn't understand that the timeliness rank was simply a relative strength measure. So I saw kind of a need to just pull a bunch of the literature together and turn it into one coherent package. I thought the book was the way to go because I thought the individual investor could use this book to kind of manage their own retirement accounts. The book talks a lot about using weekly strategies. So I thought it was something that an individual could put together on their own and kind of save the 2% more that they are charged by professionals who don't do much better than the market, if better. And I don't mean that in a disparaging way against the professionals. The professionals tend to be, that a small investor works with, tends to be a financial advisor who follows a very fundamental approach, asset allocation approach, pretty much is dictated by their firm. Low switch type strategies, just high fees to not do much. And that's the prudent person rule. That's just the way the industry works. And I think individuals can do better. That was the idea behind the book. I appreciate your words about the writing. In hindsight, I think I wrote it more towards the professional rather than the individual that I'd hoped to work with. And I think the inclusion of some exact spreadsheet type strategies would have been more useful for the individual. And then maybe we could have changed the world one individual at a time, but we didn't do that.
Are you planning a second edition where you can implement some of those enhancements?
I don't know because the individual investor, retail investor seems to be so demoralized now. The book came out right at the top, and it showed you, had you done these great things, you'd be sitting great. Some individuals who did try to apply the book did not want to follow the risk management guidelines. And to me, that's a key part of it, that it's hard to explain to the retail investor that cash is okay sometimes. You'll use it eventually, but it's okay to have cash sitting there, even at less than 1%. So that's a tough market. I think I'd have to completely revise my approach to reach that market, and I just find I don't maybe translate as well at the retail level as I was hoping to.
Okay. Well, who influences Mike Carr? Who is your favorite analyst?
Yeah, I think, you told me that question was coming, and I view that probably a little bit differently than many other people. Rather than from a trading perspective, I look at who I can learn from, because when I read history or, learn about traders, I want to try to understand what motivates them and how they do what they do. And Jim Rogers jumped out at me as a sterling example of how to live a life. He started with George Soros as a partner and was doing great. They were making a lot of money, hiring people because that's what you do when you start growing. And he said he quit one day when the secretary asked him if she could take a vacation day because he just didn't care if the secretary wanted time off. She was entitled to it. He just didn't want to be bothered by that. He didn't want to have to approve all of these little personnel actions that go on in an office. So he just quit and moved away, and he's done very well. And in thinking about him, I came up with what I call the rule of the zeros in life. And what you have to do, in my eyes, is figure out how many zeros you want in your life before you're happy. And with that, I mean your personal net worth, so to speak. There's a big jump. If your net worth is going from $10,000 to $100,000, there's a big jump in your lifestyle. There's a big jump between 100,000 and a million, a big jump from a million to 10 million, and so on. And you have to decide how many zeros you're comfortable with. Jim Rogers is probably comfortable with a couple more zeros than I am, and I mean, he's obviously fantastic. But once I realized the trade-off between adding zeros and enjoying life, it kind of came into perspective for me exactly how hard I had to work and exactly how I could work to balance those two goals. So in that way, I find Jim Rogers to be incredibly inspirational. And I know that's not exactly a trading-related answer. It's more you probably didn't expect to get a philosophy of life answer there.
Well, that's good life counsel.
And I think if people would think about what they want out of trading, and let's face it, this is a business that the dollar is how we keep score. So if you define how many zeros you actually need to be comfortable and what you want out of life, you know the target. Too often we spend all our time chasing a target without defining it. There's wisdom beyond my age, though.
What would you say is one of your more memorable trades?
One of my most memorable trades was a trade error. I had meant to buy sugar, and instead I typed in ZB with a Z instead of an F. And the trade...
ZB being bonds?
Electronic bonds, yeah. And at the time, both were going up. I didn't, because I also had bonds and another through the TY contract at the time. And I didn't quite notice the error for a few days, but my position was gaining much more than I thought it should. And I finally noticed the error, and I realized then that, geez, people do make errors. I always thought the errors were a result of, something I could prevent. And I'd always just click through those screens asking, do you want to confirm? Are you sure? All those kind of screens. I'd never read them. And at that point I realized I got lucky this time, but I'll never get lucky again. So I started slowing down and reading the confirmation screens, making position checking a part of my daily routine, and all those little things that you're taught to do. And what I realized from all that is trading is just like maybe professional sports. It's just a whole lot of fundamentals that we have to go through every day, and we have to do them better than average. I mean, if you're playing for the New York Mets, very clearly you need to be aware of the Seinfeld history, which I guess they do on their weekends. For those who didn't notice, the Mets had a bird in the bullpen this weekend named Little Jerry Seinfeld after a Seinfeld episode. But they throw a ball. We all throw a ball. They just happen to do it better, faster. They can catch. I mean, if I was trying to catch an 80 mile per hour fastball, I'm not sure I could do that. They happen to do the fundamentals better. If we want to be successful traders, in addition to knowing how many zeros we want, we also just have to execute the fundamentals a little bit better than the retail investor. So that's what I learned from a trade error, and that was really the trade that stuck out with me.
So,
these aren't real exciting stories, are they?
These are great.
I'm looking back at my life now and wow, there's so much here.
Well, as the editor of as technically speaking, you're able to control and edit what we see of you every month. Tell us something that might surprise people about you.
Probably on a typical summer month, 90% of that newsletter is written with me just sitting on a deck looking at the mountains. In the winter, I'm in front of a fireplace, and both places is just dogs. My two little dogs sprawled around. And to me, that's what's important. I decided that I just wanted comfort and my dogs to be comfortable. They are. And that's all my goal is in most days, just make sure the dogs are happy. Not exciting again, is it?
Oh, that sounds great. And you live in Colorado, so we're talking Colorado mountains?
Correct.
Well, thank you, Mike. Is there anything you'd like to share with us before we go?
There's not. I really appreciate this opportunity. I just think the MTA highlights the fact that technical analysis offers the lifestyle that you want to live. And I don't know if young traders get that. So many see Steve Cohen or George Soros and decide that's who they want to be like. But there's hundreds of our members who are enjoying exactly the life they want without the headlines. And I mean, Steve Cohen is a great example. One of the most successful traders in history, multi-billion-dollar fortune, constantly in court dealing with various allegations which have never been proven, but they're a distraction to him. I'm sure at his level they're worth it, but I don't think I'd want to go through the constant probing of lawyers that he has to endure. So younger traders maybe should look at what exactly they want out of life and then design their technical analysis career to deliver that.
Today's guest has been Mike Carr, and that concludes today's MTA podcast. And on behalf of all the MTA membership, we thank you, Mike, for your endless hours investing in the MTA organization. From Lexington Capital, LLC.com, I'm Lance McDonald, together with recording engineer Shane Skwarek at the MTA, reminding you that price is always right.